Welcome to the CFA Level 1 presentation on capital budgeting. First, let's understand what capital budgeting is all about. Capital budgeting is the process that companies use for decision making on long-term projects. The fundamental area of knowledge for an analyst for many reasons. So this is saying, why do we as financial analysts need to understand this topic? So number one, capital budgeting is used by companies, and this helps them decide the future of many corporations. So through capital budgeting decisions, companies decide what projects to do, what projects not to do, and that in turn decides or indicates what direction a corporation is moving in. Adapted for many other corporate decisions such as investment in working capital, leasing, mergers and acquisitions, and bond refunding. So all this is saying is that capital budgeting techniques that we will study later have several applications within the corporate world. The principles we'll see here are also used for valuation related work, valuation of projects or valuation of divisions, or even to some extent valuation of entire companies. Corporate budgeting decisions are consistent with management goal of maximizing shareholder value. So as we'll see later, a lot of capital budgeting is based on net present value analysis, and essentially the goal of senior management should be to maximize shareholder value, and by properly using capital budgeting techniques, this objective is achieved. So what is the capital budgeting process? First of all, capital budgeting procedures depend on the size and complexity of a project. The typical steps used in this capital budgeting process are as follows. Number one, a company needs to generate good investment ideas. Then for each one of these ideas or potential projects, we need to forecast cash flows and evaluate the profitability of each project, and then schedule and prioritize projects based on which one has more profitability or higher net present value, and also we need to take into account the strategic significance of each project. And then once a project is underway, we need to monitor it and ensure that the profitability numbers and the assumptions that we had made in selecting a given project, whether they still hold. And finally, audit refers to the fact that after a project is done, this is really a post-audit we are talking about. Once a project is done, we need to do a post-audit to make sure that that number one, that we achieved the objectives that we set out to achieve, and if not, then we need to understand the reasons and learn from those reasons. There are different categories of capital budgeting projects. Number one, replacement projects. So if we are running a given machine and that is getting old, replacement of that machine would come in this category. So replacement projects are necessary because we want to maintain our business. We might also do a replacement project as a cost reduction exercise. Say a given equipment that we are using has become very expensive to maintain. The changing of that equipment for another more efficient piece of equipment would be a cost reduction exercise. Expansion projects, these might require more complex decision making. So if you have a factory that makes shoes and you want to double the capacity, so clearly one has to figure out what are the additional costs, what are the additional cash inflows, and based on that decide whether or not the project makes sense. New products and services, so this refers to situations where a company is deciding whether to get into new products or new services. Clearly this will require complex decision making because a company has to figure out what the additional cash flows will be, what the costs will be, and so on. And there is going to be significant uncertainty about cash flows relative to some of the other categories. And the fourth category that we are looking at is mandatory projects. These are required by government agencies or insurance companies, and they typically generate little to no revenue. 5 key principles of capital budgeting, and from an exam perspective this is very important. The first one is that decisions are based on incremental cash flows. What this means is, let's say that you are currently running a machine and the annual cash flows for this machine are plus 20, so let's say 20 million a year. Now if you replace this machine, so let's say that this machine is replaced with a newer machine, then for the new machine, let's say that the total revenue now is, or the total cash flow is 30 million. The analysis should be based on the incremental cash flow here, which is 10 million. So the incremental cash flow is 10 million. We need to look at the additional cost of bringing in this machine. So by additional cost we'll mean the cost of disposing of this machine, and that needs to be taken into account. So the incremental cost, let's say the value of this machine is 50 million, and you will get 25 million by disposing of this machine. The incremental cost is 50 minus 25, and then the net cash flow generated by this machine is 30. The net cash flow that was generated by the old machine is 20. In our analysis we will look at the incremental cash flow, which is 10 million. So this is a very simplistic look. Obviously if you are looking at a complex project where you need to compare several line items, for every line item you need to look at the incremental cash flow, not the total cash flow. Now let's look at a couple of other important items. One is the concept of externalities. Whenever you are doing a project, you must also take into account externalities. Externalities is the impact on other projects. So as a quick example, let's say that we are looking at launching a diet Pepsi drink. So let's go back in time a decade or so, when we just had regular Pepsi, and let's say that Pepsi in Pakistan is deciding to launch diet Pepsi. If they had they done a NPV analysis or a cash flow analysis, which I'm sure they did, that cash flow analysis should also look at the impact on regular Pepsi. So just making up numbers here, but let's say that the annual cash flows that are projected for this new diet Pepsi project was, let's say, plus 10 million rupees a month. And let's say that by doing this project, the expectation is that the net cash flow for regular Pepsi will go down by 4 million. So in the analysis that Pepsi should have done, they should have considered that the net effect would be 6 million, and this is the number that should be used in the cash flow analysis. The example I have given you here of a negative impact, this is called a negative externality, and the term used for this negative externality sometimes is cannibalism. The reason being that Pepsi is cannibalizing its own sales by introducing a diet Pepsi drink. And the reason a company might do this is that overall they might have a higher cash flow, but in determining whether or not to move forward with this project, we must look at the external effect. So this was an example of a negative externality. Externalities can also be positive. For example, if Pepsi now decides to launch a chips business. Okay, so let's say that they are deciding to launch Lay's chips in Karachi, and they determine that by selling Lay's chips, that will increase the sales of their soft drinks. So the increased sales should also be factored into the cash flow analysis for the new chips project. So that's what you need to know about externalities. Sunk costs are costs that have already been incurred, and when you do capital budgeting analysis, sunk costs should not be considered. The point being that this is water under the bridge, it's money that has already been spent. So for example, if Pepsi spent 2 million on an analysis of whether or not to launch regular Pepsi, that 2 million has already been spent, and that figure should not be used to determine whether or not to go ahead with the project. So project decisions are based on incremental cash flows and cash flows that are to come in the future. Point number 2 is that we must consider opportunity costs. So the point here being that even though opportunity costs are not explicit costs, but these are costs that must be considered nevertheless. So for example, if you are running a business out of your parents' warehouse, so your parents have the spare warehouse that you could rent out for, let's say, 25,000 rupees per month, but instead you decide to run your own trading business out of this warehouse, and clearly let's say that your parents do not let you use this warehouse for free. So the point is that when you do your analysis in your cash flows, you need to subtract the 25,000, because this is an amount that you could have easily received by renting out the warehouse. And to give you an example of why this is so significant, let's say that your net cash flow without considering the cost of the warehouse is 20,000. Now, if your net positive cash flow is 20 plus 20,000 despite all the efforts that you put in, then clearly it does not make sense to do this project, because you could have easily received 25,000 as rent without having done any work. So on the other hand, if you do consider the 25,000 expense and you subtract this from here, then you will notice that you will get a negative cash flow, and that will make it obvious from looking at these numbers that you should not go forward with such a project. So bottom line is, include the opportunity costs in your cash flow analysis even though they are not explicit costs. You must consider the timing of cash flow, and now that you understand time value of money, this is well, I hope you understand time value of money. If not, we will see examples of this very soon. But clearly, if you receive $100 1 year from today and then another $500 3 years from today, you need to, when you do your analysis, make sure that you have a timeline and you understand where the cash flow is being received, because $100 today is different from $100 1 year from today, which is different from $100 2 years from today, and so on. A general approximation that is often used in capital budgeting is that all the little cash flows that you might be receiving or making during a year are all bundled up and projected as cash flows at the end of the year. So this generally is a conservative assumption, especially if you are receiving cash, but for simplicity and in most cases in the CFA curriculum, you'll notice that these incremental cash flows are bundled up and projected at the end of every period. Point number 4 is that you must analyze cash flows on after tax basis. Point being that tax is a real cash flow. It's real money that you need to pay the government, so you need to factor this in when you are doing your analysis. And finally, and extremely important from a potential exam question perspective, finance costs are reflected in the rate of return and hence should not be shown in the cash flow. So what does this mean? This is a slight precursor into what you will see later. But let's say that you are generating 100, 100 and 100 over the next 3 years, given an investment of, let's say, minus 200. So an investment of 200 now, and you are generating this cash flow. The question is whether to subtract finance costs slash interest costs from these numbers? And the answer is that we do not. The reason being that when we discount these numbers, we are discounting using weighted average cost of capital, which includes the finance costs. So if the finance costs are high, that will result in a high cost of capital and hence a low present value. So because finance costs are already built into our discount factor, we should not subtract them from the cash flow also. If we subtracted finance costs from the cash flow, that would be like double counting, because we would reduce the numerator and increase the denominator, which will have a double effect. So remember, finance costs are only included in WACC. They are not included in the cash flows. Some important definitions. Independent projects means that two projects A and B do not depend on each other. So that simply means that doing project A says nothing about whether or not you should do project B. And the basic idea here is that if it makes sense to do project A and it makes sense to do project B based on the sort of analysis that we will see shortly, then just do both. Mutually exclusive projects X and Y, for example, this means that if you do X, then it doesn't make sense to do Y, and vice versa. If you do Y, then it does not make sense to do X. And this would be, let's say, that there are two different projects to build the same sort of widgets. Then either you will build it using machine X or machine Y. It doesn't make sense to invest in both the machines which have a similar function. Project sequencing refers to the order in which you do projects. So at times, to do a large project L, it might make sense to do a small project S to set things up for the large project. So the order in which you are doing projects is called project sequencing. In the context of capital budgeting, we can have very infrequently a situation where there are unlimited funds. This means that we have enough funds to do whatever positive NPV projects we can find. And if you don't understand positive NPV projects, we will talk about that soon. But essentially, you can think of it as follows. A company has enough money to embark on any profitable project that it can do. The more common and realistic scenario is that there is some capital rationing going on, which means that there is some budget. So they say a $10 billion project for a large company, and then with this 10 billion, a company has to basically figure out which projects to do and which projects not to do in this budget. So that exercise is called capital rationing. Investment decision criteria. The two most comprehensive measures of whether a project is profitable are number one, NPV or net present value analysis, and number two, IRR analysis. We'll talk about these on the next few slides. There are a few other criteria that are also used, and these are the payback method, discounted payback method, and profitability index. Let's start about talking about net present value. You have seen this already in quant, so this should be a review. But essentially, the net present value is the present value of future after-tax costs minus the investment outlay. And because we are minusing the investment outlay, that's why we use the term net in the expression net present value. So this, in case you are confused by the sigma sign, it simply means a summation of all the cash flows from time t equal to 0 to t equal to n. So on the next slide, I'm going to show you an example, but all we are doing here is discounting all our cash flows to the present. And the NPV rule for independent projects is that you accept any project with positive NPV and reject any projects with negative NPV. If you have two projects X and Y that are not independent, so you can only do X or Y, then clearly you do the project with the higher NPV as long as NPV is positive. So let's look at a simple example where you have two projects A and B. Let's say that these are independent and you are given the cash flow over a 4-year period for project A, cash flow for project B over 4 years, and you are given your discount rate or your cost of capital. So you will see different terms here. Here I've used the term cost of capital. You might also be given the weighted average cost of capital or WACC, which we will study in the next reading, or you might be given something called the interest rate for this project, or you might be given something that says the discount rate. So all these would typically be somewhat synonymous. Now, how do we calculate the NPV? There are two ways. One is the long-winded way, which you should understand the way you should understand the concept, and then what you need to do on the exam is use the calculator, and you will see how to do that on the next slide. But NPV for project A is simply going to be minus 1000 plus 500 over 1.1. So 500 is going to be discounted back 1 period, plus 400, which is going to be discounted back 2 periods, so that's 1.1. 1.1 because the interest rate is 10%, so 1 plus 10%, which is 1.1, and discounted back 2 periods, so 1.1 squared plus 300 over 1.1 cubed plus 100 over 1.1 to the power of 4. And if you do this, you should get NPV equal to 78.82. So based on the NPV rule, you would accept this project because the NPV is positive. Project B, you use a similar analysis, and you obviously use the numbers given here, and if you do this calculation, you should get NPV of 41.18. Now just a few points I want to highlight with these two projects. Number one is, if these were mutually exclusive, then obviously you do project A because it has a higher NPV. Another point I want to highlight is the importance of the timing of cash flows. If you look at both projects, in both cases we've invested 1000, and if you simply look at the undiscounted cash flows for project A, if you add up these numbers, you have 500 from here, so you have a total cash inflow of 1300. And if you look at project B, which has a lower NPV, but the sum of the undiscounted cash flows is 1400. So why is it that with projects, so an accountant who doesn't understand present value would possibly be more inclined to go with this project? But the big difference is that in project A, you are getting your money back faster, and the present value of money back faster is obviously higher, versus in project B, you are recouping your investment towards the end. So even though the project has a positive NPV, but the NPV of project B is lower because of the difference in timing of cash flows. So this is a important point, and I will come back to this later. Now the example that you just saw, this is how you must do it on your calculator. So you've seen this before in quant, but just as a quick recap, you need to plug in cash flows and plug in the interest rate. So how do you do this? The first thing that you do is hit your cash flow button, which is right here, and then typically the calculator will have stored prior data. So to clear your cash flow registers, do the second and then clear work, and then start entering. So the first entry was negative 1000, so you do 1000 plus minus to make it negative, hit enter. That will make cash flow 0 equal to minus 1000, down arrow, and then enter 500. That makes cash flow 1 equal to 500, down arrow again. That simply you will see F01, which stands for frequency, so that 500 is just happening once, and then you make the rest of the entries. Once you are done with the fourth entry, then hit the NPV button, and 10 to indicate that the cost of capital here is 10%, and hit enter, and finally down arrow again and compute, and the calculator will give you the NPV. So just for practice, make sure you do this for both project A as well as project B.